Good morning, I'm Malcolm Grahamwood and I'm here at Core Finance for my CEO interview. My guest today is Andrew Austin, Interim CEO of Kistos. Good morning, Andrew, great to see you.
Good to see you, Malcy. How are you?
I'm very well, thanks.
I had to put a different shirt on this time. I got a lot of criticism last time for wearing a shirt. People said, couldn't he actually afford one that fits? So I've tried to make sure I got one to fit. Thank you very much, I appreciate that.
And I like today's as well. So interim CEO still.
Yeah, watch this space. I think you'll find that the band will be back together sooner than you might think.
Great stuff. Now, normally I ask for maybe an overall rundown. I don't think we need to do that. Everyone knows the company. It's already at 350p, which is the high, 300 million market cap, and so on. So, since we last met, you've completed the Tulip deal, and you've got on with things in the way that you normally do. How's that bedded down, and how's the company settling in compared to your expectations?
It's gone really well. We've integrated the team in the Netherlands. That's all working very well. So we commenced the drilling campaign. As you know, we drilled up the Wieland appraisal well, which went extremely well. And we're in the process of converting 42 million barrels of 2C into 2P there, net to us. And then in the meantime, we've had this sort of, and now we're continuing to work. We're doing 2 workovers right now. So there's a 4-month drilling campaign, 2 workovers right now, and then we go on to do the Q11B appraisal well, and we should be drilling that in late November with results coming out in December. So that's pretty important for us as well. So you'll start seeing more information coming out of the results of that drilling. Before we then move the rig on to the Q11B location.
Good stuff. I might come back to the drilling in a minute. I think we should at least try and address the gas price. I don't think anyone, been talking to other people in the industry. There's no point in trying to call where it's going or try and suggest any number of reasons what's happened. But importantly for you, how's it impacted on Kistos? Does it change your production? Does it?
It doesn't affect our production. Obviously it means that every molecule that we get across the flange and we can sell is massively more valuable. Yeah. We did the CPR, and putting it in Dutch context now, we did the CPR when we acquired the assets at about 16 euros a megawatt hour. It then went up to 25. We hedged 25% of our production. That, yeah. And now it's trading at, last week it was trading well over 100.
Hedged anymore?
No. And I'll explain why. But firstly, that just means our cash generation is huge.
Yeah.
So at our expected exit rate for the end of this year at sort of 7,500, 8,000 barrels a day equivalent, we're making $1 million a day.
Yeah.
The gas price is so volatile that I can't tell you today whether it's $1 million, $1 million, €1 million, or £1 million. At various times last week it was £1 million. At other times it was $1 million. So, it's a lot of free cash flow to be coming off the assets. In terms of hedging, our attitude, and even going back to Rockrose days, our attitude has always been hedge to make sure that you can pay your bills to your partners on your capex.
Yeah.
The irony is, the more it goes up, you've got so much headroom, you actually don't need to hedge. If you're sitting there with a marginal field, it costs you $32 a barrel to produce, and you're selling it at 38.40. Yeah, you need to hedge because you can get squeezed really quickly. Yeah. But if you're making 90, 95% margins, with this kind of volatility, it's actually better not to put new hedges in place at the moment. But we could do, but we had a conversation about it when we were in the Netherlands 2 weeks ago at 40 euros a megawatt hour for the whole of next year, and now it's 60. So, it's not. You also need to bear in mind there's huge. You've got to be careful about where your margins end up on this as well, because you've got margins on your hedging, and so you can actually end up sapping quite a lot of liquidity through margin calls on your hedging.
And I would suggest, only personally, that most investors are there to take advantage of the upside that this brings, and to see it all hedged off to nothing would take away.
Yeah, because then you're just left to your operational position. And I also think, and we've experienced this the other way around, when you've had hedges up here and the market's dropped, that it can become actually an unnecessary comfort blanket. So in a falling market, hedging can give you a full sense of security for too long, where you need to be addressing costs within your business, or addressing the way in which you run your business. If you've got hedges and you say, well, I'm hedged till the end of 2022, 2023, I don't need to do anything about it. Yes, you do, because yeah. So I think it's really important to make sure that you can honour your commitments to your partners, and therefore we've always taken this attitude of hedging to cover your capex and making sure.
I think that's absolutely perfect, and I know a couple of others are doing the same thing, which I thoroughly approve of. In terms of, you suddenly think on occasions like this, because you've got extra cash flow that you were talking about, that you can accelerate or increase the size of your drilling program. Now, a few minutes ago, you mentioned your drilling program, but presumably that hasn't actually changed very much because it was set in stone. Or do you have the ability to say, I can take another rig, or I can do some more?
No, and there's 2 points on that I'd like to bring out. But we had a plan, and the plan is in presentations that are on the website in terms of this drilling program that's going on right now, putting in place the pipeline to Imalden to give ourselves a more higher level of reliability and control over our own destiny in terms of, and also improved emissions performance in terms of the export of the gas from the Q fields. And then going on to develop Veland, going on to develop Q11B. Now, these are things, particularly in the case of the Veland, that we might have previously needed to go and raise more debt for or whatever to do. We're generating cash at a rate at the moment. We won't need to raise debt or equity to push the entire program that we've got forward. So that gives us a lot more confidence on that side. Now, one of the ironies is that, and I've been asked this a number of times recently by investors, are you seeing the cost of services going up as a consequence of the much higher oil price? And the answer is no. And part of that is because of the reasons why the gas price and the oil price are going up. So the gas price and the oil price have been going up because of a lack of investment and people not developing things, which means that actually the services aren't being used. So the cost of exploiting this is not actually particularly rising at the moment. Whereas when you've seen previous squeezes on hydrocarbon prices, you've seen the cost of services going up.
You mentioned the Veland discovery. I guess that you've seen the data and you've seen the numbers. Have you changed your estimates for the size of the discovery? Or
no, not at the moment. We need more analysis of the downhole pressure measurements that have been taken. We're working that up right now. We're working out what the minimum amount of oil that's connected is. But at the moment, we're confident that the previous numbers that were in the spool report are certainly a good place to be starting from. So no, we're confident with where we stand.
They're hardly likely to be any worse, I imagine. So before we leave Tulip, upside to come?
Well, I mean, the upside is
next year and so on.
You've got Q11B, which we're appraising. Hopefully we'll bring that on within about a year of the appraisal finishing. Then we've got Veland. We've still got M10, M11 off in the north and the Shelling area. These are all discoveries. There's a lot of organic growth within our portfolio. And I think that's really important at the moment because, I'm sure you're going to come on to acquisitions and things like that anyway.
That's my next question.
But it can be quite complex right now because, you don't really know where on the dartboard you're shooting because the price is, it's not just the fact it's moved up so much, it's just so volatile. We're seeing 20% movements, even in 1 year out futures in the course of a day. So pricing things is really difficult. So actually having a good organic portfolio, which you can, is discovered, and is in a stable regime like the Netherlands, is really a really strong place to be. And we were fortunate. Yes, we got fortunate on timing, but we were fortunate to have that within the portfolio we purchased.
Which is good. So from organic, you knew that I would come on to talk about acquisitions. I've always known that you've always had, you're looking at 1, 2, 3 acquisitions down the line. Whenever I ask you, you'll say, I've got something in mind. It doesn't always happen, I remember from the old days. But I take it you're looking at acquisitions. What sort of type, size, area will you be looking at? I mean, and whilst you're talking about it, have potential acquisitions suddenly got more expensive?
let's address the size and type. I mean, again, the same sort of sizes as what we're doing now. Yeah. So we want things that are in Europe. Yeah. We're not going outside of Europe. So that's our remit. So UK, the North Sea generally, Norway if we can find the right thing. Again, not exploration, but production plus appraisal stroke development. Those are the kind of things we're looking for. But we're also with a low carbon agenda as well. You're not going to find us buying clunky old stuff.
Yeah, I mean, that's my next question. Tulip, very low carbon play.
It's really hard to actually find something that's to find something that's accretive to where we stand is basically impossible. But to find something that is, significantly below North Sea averages, there are things out there, and we've looked at a couple of things, and we still continue to look. I think we're involved in about 3 negotiations right now on other assets. One of the things that's happening is if you buy something that's got an effective date in the past, the amount of cash that's accumulated through the time up to the effective date has changed. So to your question, if a major makes a decision to dispose of something, they've usually made that decision, and they're not going to necessarily change their mind because the price might have gone up. But what does happen is that by the time they actually get to close the disposal, the amount of cash that's accumulated in the asset could easily be the large part of what the acquisition cost is.
Yeah. And you'd always do this sort of acquisition that you would be control of, be all yours. You wouldn't, say, farm into, if another company in the North Sea was farming out a 50% stake in a gas field, you wouldn't...
Yeah, we can do that as an asset deal as well. We're not, we're operators at the moment in the Netherlands, but we've also, a number of the things we're looking at are non-operated portfolios.
Yeah.
So we're agnostic on that, frankly.
Yeah.
It's just a question of getting something that fits, that we can get at the right price, plus has the right carbon story. And the carbon story point is really significant.
Yeah. I mean, going forward, we're seeing all the companies saying they're going to do it or trying to get there to a certain position. You're in a very strong position, having got there already with the electrification and from onshore and all that sort of stuff, and unmanned and
well, it's even better than electrification from onshore because we're powering it with wind and solar on the platform itself. And we're looking at. You'll have also seen that in terms of the gas compression station that we're looking to put together on the Dutch shore. Yeah. We're in exclusive negotiations with a local wind farm to basically buy that wind farm to power that gas compression.
Sure that, yeah.
So that's really showing the direction we're heading here. Yeah, we're looking at it to be in a place where we can really impact our Scope 2 emissions as well as our Scope 1 emissions. Yeah. And we're seeing that come through in the gas price as well. So we were in talks with a major utility before the gas price went completely silly. And by the way, I quite like silliness in that sense. The silliness is very profitable. Where people are saying, okay, if you can deliver us gas, which has a lower Scope 1, Scope 2 emissions than the average across the North Sea, for our customers who are looking to offset Scope 1, Scope 2, Scope 3, that gas is more valuable. Yeah. So can we buy your gas with that certification and pay you more for it? Now, then the gas price just went nuts. And as a consequence, those conversations have not progressed at the moment. But I think we're very aware that the gas we have is more valuable than that produced from, say, LNG or from an old platform that's doing 25 to 30 kilos per BOE of CO2.
Yeah. Excellent. I'd like to move on to what I'm calling sort of debt, dividends, payouts, and so on. Historically, you've always been, well, first of all, you've always been a big holder of the equity in the company you run, and that hasn't changed here. You put a lot of money into into Kistos when you came to the market. You've always made a point of doing share buybacks or dividends or one-off payments and so on. I assume maybe wrongly, but I'm assuming that once Kistos gets to the size and with the cash flow that you've been talking about and so on, that may be the case. So I'd be interested to see what your thoughts are about that. And also, whether the fact that you've got a bond which prohibits you paying dividends at the moment makes any difference to that.
Well, I mean, it doesn't make any difference to the objective. The objective is very clear, and the objective is to pay and distribute cash back to shareholders. We did that at Rockrose very successfully, and we're committed to doing it. We're not running this as a lifestyle business. We're running this for the equity. The equity is what motivates us. It's certainly what motivates me. We do, under the terms of the bond, have to get Q11B up and developed before we can pay a dividend, or we have to pay the debt back. Now the debt is trading at a significant premium to par right now. I mean, it's over 105 because the credit story has also massively improved, and at the kinds of cash generation rates we're looking at the moment, we could easily have the debt covered in cash within quite a short period of time. So we're looking at is we need to get Q11B up and running. Obviously, that relies on the appraisal that's happening.
Which is sort of end
of
22?
next year, end of next year, beginning of 2023. And then, yes, we will.
Yeah. The other thing is that at Rockrose, again, to mention that you built a highly successful business that you subsequently sold, in my view, a bit too early, but because of the what was going on in the world, it was at knockout price, which you accepted, and so did the shareholders. And the good thing was they knew that they would come back with another vehicle. Have you got the same sort of idea with regard to Kistos?
Well, I didn't run Rockrose to sell it, and I don't think it's ever the right thing to run a business to sell it. I think you need to run a business to do what you think is right for the business. And if you're doing that right, then people will spot that and come along and potentially show interest in the business, which is what happened in Rockrose's case. Yeah, I mean, if we'd continued with Rockrose, I mean, it would be trading probably significantly higher. But there's a lot of things that happened in, March, April, May of 2020 that, jobbing backwards on that one, Malcy, there's an awful lot of bargain stocks that were out there. We were sitting in an oil price environment of less than half where we are now. We were just hitting when it went negative. I think it was the right thing to do, to sell it. But I'm not running Kistos to sell it. I'm running Kistos to generate the best cash returns we can for customers. But on the other hand, if the prices of assets continue to go up, such that we can't find something that's accretive to buy, and someone walks in and says, well, okay, we'll buy Kistos at the right price, we'll always look at it. We're traders at heart, really.
Well, I mean, and that's the business world has lived since the 60s, when people said, everything is for sale at a certain price,
But not this price.
Certainly not this price. No way. I mean, you've only tripled the share price this year so far.
I know, but you've already wrapped me over the knuckles for selling Rockrose too cheap. I can't believe that. Honestly, turned 13 million into 297.5 million in 4.5 years, and I get told off by you.
And the shares were only 10 quid off the top when you sold them, weren't they?
2 quid off the top.
Yeah. We're nearly out of time, unfortunately, because I love talking to you, and it's great to hear what you're doing with the business, and again, being successful. Obviously, the question is, again, which you've answered to a large degree, but where do you see Kistos in, say, 18 months' time, when you've got Q11B and so on and things happening?
Well, we see it being a business producing 25,000 barrels a day off the existing organic position we're in, without having had to come back to the money market for any more debt or equity, potentially having paid back a significant amount of its debt. What we don't know is where the gas price is going to be. But I think fundamentally, the gas price may well come back from where it is, but it's not going to go back to trading at a discount to oil in the same way as it did. Systemically, it's, you and I know it's been trading at a 30% discount on a BOE equivalent basis for many years.
That ship has sailed.
I think that ship has sailed.
Yeah.
And if you take it and convert it into, at 90 euros, you're talking about $160 a barrel equivalent. are you going to see that gap remaining that wide? Probably not. Do we think that both are going to probably drift back towards each other? Yes, the oil price will probably come up and the gas price may well come down a bit. But that systemic gas trading at a discount to oil, I think, has gone for a significant period of time.
It is interesting that you talk about this like this, because we're talking about gas to oil and what's the call on the power for first, and people saying, right, we're actually moving power stations over from gas to oil and so on. But I was reading an article saying that in the last 5 nights, the UK has not used any of the wind or that's available to them, and last night almost everything was from the coal stations that have been brought back on and the gas and oil power stations.
Well, it's been a perfect absence of storm, hasn't it?
Yes.
I mean, that's the point, is that, the whole summer has had very low levels of insulation, there's the amount of sunshine that's come down, and the amount of wind. It's been almost windless. And, that's the problem, is that at that point, you need gas to be your backup. No, we shouldn't be producing from coal. That's definitely not where we want to be. But we do need gas in the mix, and that's what squeezed it.
But this has never been my idea. But I think I've been writing for 10 years or more about why governments will not get involved in storage in the gas stations and gas fields in the North Sea. But that's for another time. Before I go, when I mentioned on the Twitter sphere that I was seeing you, as you imagine, it went ballistic, and everyone's absolutely delighted, and I got many questions. 2 of the questions I got in I thought I'd save for the end. One is, will you ask Andrew to be my son's godfather? And secondly, will you throw a party at 500p? You don't need to answer.
I don't think I can answer either of those. But if you want to do something, if you want to do something for your godson, then just put away a few little shares in Kistos and look back at it in a few years' time when he's 5 and see how it goes.
Yeah, well, you couldn't have said any better. Great to see you again, Andrew. Thank you very much for your time.
Always a pleasure.
It's been great to talk. Hi, we finished the interview with Andrew, I'm afraid, but it's been a great chat. And I'd like to thank again for joining me here at Core Finance for my CEO interview. I'll be back next time with another CEO. Look forward to seeing you again then. Bye now.